All right, welcome. Today we're going to break down a topic that's, well, it's absolutely essential for anyone in a business partnership, your tax basis. It might sound a little dry, but trust me, getting this right is a huge deal. And as you're about to see, the stakes have gotten a whole lot higher lately.
So, let's just jump right in with the most important question, right? If you're a partner in a business, do you really know your basis? I mean, not just a vague idea, but the actual calculated number. If you're hesitating at all or thinking, I'm not so sure, then you're definitely in the right place.
And this isn't just some boring accounting exercise. The IRS is actually calling partnership basis a hot issue right now, and they've seriously ramped up their enforcement. Not keeping track of this number can hit you with some pretty big penalties, which we'll definitely get to.
All right, so let's start from square one. Let's get right to the heart of it. What in the world is this thing everyone calls basis?
Okay, so here's the simplest way to think about it. Your basis is basically the official number the tax code uses to track your investment in the partnership. It's the starting point, the foundation for figuring out all kinds of tax stuff, like the money you take out or the losses you can claim. Okay, now here's where it gets a little more nuanced. There are actually two different kinds of basis, and this distinction is super important because only one of these is actually your job to track.
This really breaks it down perfectly. Think of inside basis as the company's point of view. It's the partnership's own record of its assets, the computers, the equipment, all that stuff. But outside basis, that's all about you. It's your personal story, your investment journey with the business.
And that's the one we really care about today. That's what shows up on your personal tax return. And here is the absolute key takeaway. The partnership, they're not required to track this for you. Nope, that job, it falls 100% on your shoulders. Okay, so to make this whole thing way less abstract, let's use a simple analogy for the rest of our chat. From here on out, just think of your outside basis as your personal tax basis scorecard. Simple as that. It's the running score of your investment in the game. So how does this scorecard actually work? I mean, it's not a static number, right? It's constantly changing. Think of it like there are four main levers that can push your score up or pull it down all year long.
So first, let's talk about what adds points to your scorecard. You put more cash or property in, your score goes up. The partnership makes money and you get your share, score goes up. And here's a weird one. If your share of the partnership's debt goes up, so does your basis. It's kind of counterintuitive, but that's how it works.
All right, so what about the other way? What subtracts points from your score? Well, you take money or property out, score goes down. The partnership has losses or expenses it can't deduct, your score goes down. And just like before, if your share of the partnership's debt goes down, that also pulls your score down.
Okay, but here's the single most important rule of this whole game. Your score can be whatever, high, low, even flat at zero. But here's the kicker. It can never, ever go below zero. And that one rule, that's what triggers pretty much all the big tax headaches we're about to talk about. All right, so we know what basis is, we know how the score changes, but why should you care? Why does this number matter so much? Well, let's walk through two super common situations where it becomes absolutely critical. Okay, scenario one, losses. Let's say the business has a rough year and your share of the loss is, say, $50,000. The big question is, can you actually use that loss to lower your taxes on your personal return? Well, the answer is, it depends. You can only deduct losses up to the amount you have in your basis. So if your scorecard only says $20,000, that's your limit. That's the most you can deduct this year. That other 30 grand, it doesn't just disappear. It gets put on hold, suspended, and you have to carry it forward until you build your basis back up in the future.
Okay, on to scenario two. This one is about taking cash out of the business. You get a distribution from the partnership. Is that money taxable?
Usually the answer is no. It's seen as just a return of the money you already put in, so it's tax-free. But you remember that golden rule, right? The one about never going below zero? So, let's say your basis is $10,000, but you take out $15,000. That $5,000 that tries to push your score below zero, bam, that instantly becomes a taxable capital gain.
And all of this brings us to the real reason we're talking about this right now. This isn't just theory. The IRS knows for a fact that tons of partners get this wrong, and they've just made a huge move to crack down on it.
This has always been a pet peeve for the IRS. But tracking it down was always kind of tricky for them because of how things were reported on the Schedule K-1. Well, that's all changed.
The IRS has new rules now. They're forcing partnerships to report every partner's capital account on a tax basis.
What this does is shine a huge, bright spotlight right on these numbers. It makes it super easy for them to spot anyone who's taken deductions they shouldn't have or received distributions that should have been taxed.
And if you're wondering why partnerships are suddenly snapping to attention, it's because of this number, $23,400. So, what is that?
That's the potential penalty per year for a small firm with just 10 partners if they get their Key 1 reporting wrong. It's $195 per partner per month. You can see how that adds up like crazy. It's a huge financial incentive to finally take this seriously.
And that brings us to the final, most important thought I want to leave you with. You're going to get a K-1 every year, and it's going to show a capital account number. But is that number your actual tax basis? Probably not. It's a starting point, sure, but it's not the final answer. Figuring out that true final score on your personal scorecard, well, that responsibility has always been and will always be yours.